Welcome back. Well, like we pointed out, it is a bit of a sluggish session, you'd have to say, for the financials. We have the Nifty, which is just about consolidating, and the Sensex, which is down around 80 odd points. Well, let's get talking about talking to a couple of companies then. SIS is in focus. It reported what was a good fourth quarter with healthy revenue growth in both its security solutions as well as the facility management verticals. It has also cut its debt to around 862 crores. Will growth and margin sustain in FY24? We have Dhiraj Singh, who's the CEO at SIS, joining in to take some questions. Mr. Singh, hi, thank you very much for taking the time out. Well, before we get talking about the entire business and what revenue and growth is looking like, just wanted to actually touch upon the balance sheet, because you have reduced your debt on a Q1Q basis. It's come down from close to 1,000 crores to around 862 odd crores. What is the guidance going into FY24?
Hi, good afternoon. So our debt equity ratio, which was in Q3 around 1.8, near to 2 almost, we brought it down to actually less than 1.5 now. In fact, we've repaid another 15 million Aussie dollars, more than 80 crores. So our debt is less than 800 crores, and that's a comfortable debt equity ratio of 1.5 as of now.
Okay, that is on the balance sheet. Let's talk about your business and your vertical, that is the India Security Solutions business. There has been a margin recovery and you've been continuously working on that, but it's still not back to pre-COVID levels. What's the outlook here? You did see some deal wins in the quarter gone by. Has that momentum continued in quarter one as well? And what about margins? What are the triggers from here on?
So if you look at the past 2-3 quarters, other than one blip in FM facility management segment for the Q3, we've been growing on a margin percentage quarter by quarter, and we expect all the 4 quarters in the coming financial year to show similar trend. We are working on the gross margin side, whether it's looking at our internal costs and controls, as well as going to the clients and asking them for the right pricing, as well as the SG&A structure, which had been a little ignored in the past because of our growth focus. But now we are looking at the balance, and our overhead structure is something, again, we are looking very carefully this year. Both of this combined will yield reasonable improvement in the margin going on a subsequent quarter-by-quarter basis.
Okay, so when you say reasonable improvement, you know, the highest level we've seen in terms of margins for the past couple of years is 6%, and you came down to around 4.3% in FY23. So what is the best level that you can probably do in terms of margins based on the business model?
So India business, we expect the margins to stabilize at about 6 to 6.5%. And internationally, if you look at the past also, it's traditionally been around the 5% mark. So combined, we are looking at between 5.5 to 6%, which we expect by Q4 in the coming financial year, we should be able to achieve or be very near to that.
Okay, combined blended margins could be between 5.5 to 6% in this financial year itself?
Yeah, by the Q4.
Okay, all right. So this is about your blended margin picture. One segment that has done really well for you has been the cash logistics business. In FY23, reported highest ever revenues, and you've seen a growth of around 38% in revenue, 60% in EBITDA as well, with margins of around 15.8%. What is the outlook here? Will this growth continue? Is there an option or a recovery, or I would say expansion in margins expected here as well? Also, you were looking at spinning this off. Is that on cards this year?
Cash logistics is definitely one of the business that we are very excited about. It has been growing on both the revenue and the EBITDA side. As the scale grows in revenue on the balance sheet, as well as on the ground, as the ATMs consolidate more, there's more efficiency in the route-based transport logistics. We expect the margin profile to improve. Also, we are looking at positioning this business more as a banking support solutions provider, and that's throwing up many new opportunities with higher margin profile. So we are definitely looking at both the growth in revenue and the EBITDA. On the second part of the question, absolutely it is on our priority list to monetize this at some time in the near future, hopefully through an IPO.
Okay, well, we have some updates coming in on Z Entertainment. The SAT or the SAT has asked SEBI to file a reply in the next 48 hours. They will be hearing the matter and deciding on Monday and not going to pass an interim order today. Remember that the Securities Appellate Tribunal was going to take up the Zee Entertainment promoter plea, which on June 15th. And remember that they had moved SAT challenging the SEBI ban as well. So basically, those are the developments which have taken place at this point in time. And SAT has asked SEBI to file a reply in the next 48 odd hours. So we'll be hearing about these developments in the next couple of days as well. But so can you just come back to the margin picture? I just wanted to understand about the facility management services business. That was up over around 30% in FY23 on a year-on-year basis in terms of revenue. So that segment has done well for you as well. But are you seeing a lot of competition come in? Are margins lower within that segment?
The facility management has seen a small blip in Q3, as I mentioned, but it's been improving. It went from 4% to 4.4% in Q4. Again, we expect the similar trend to continue. In one of our business, Service Master, the royalty that we used to pay to Service Master in US, that has been reduced and will be effective from Q2. So that will again improve the margin profile on one of our large SBUs in the facility management sector. What is happening in this particular segment are a lot of companies providing simple manpower-based solutions or services. We are moving very rapidly towards the digitization and automation in this segment. We are also moving up the value chain to provide as one SIS a total integrated solutions to our clients, which will see a higher margin profile going forward.
Okay, all right. So that's on facility management. I just wanted to circle back to cash management because you said that could be monetized via an IPO. Any timelines you've set there, any sort of valuations you're looking at? Because we did see listing of a lot of cash management companies in the markets in the last 2 years. What is your timeline looking like?
It might be possible in this financial year itself. I wouldn't like to comment on the valuations at this stage.
Okay. All right, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's SIS. The stock is up around 2% in today's trading session. Well, for the markets, nothing really to write home about in terms of any movement from the last time we checked. We still have the Nifty down around 16 odd points. So quiet day for the frontline indices. Time for a short break. Once we're back, we put the spotlight on the Indian fluorochemical space and the key growth drivers there.